September 15th, 2008. Employees at Lehman Brothers walked into their offices that morning, not knowing it would be the last time. No warning, no phone calls from America, just silence, then bankruptcy, then the worst financial crash since the Great Depression. Now in April 2026, the Bank of England, the world's most respected financial institution, just said 4 words that should terrify every American with a bank account, a pension, or a 401k. The echoes are back, and this time, the bomb is $2.5 trillion bigger. To understand what's happening, you need to understand one term: private credit. After 2008, governments forced traditional banks, J.P. Morgan, Bank of America, Wells Fargo, to follow strict lending rules. Banks had to hold more capital. They had to reduce risky loans. They became cautious, but companies still needed loans. So a new system filled the gap. Private credit funds, run by giants like BlackRock, Blackstone, Apollo, and KKR, started lending directly to businesses. No bank in the middle, no government oversight, no transparency, and people loved it. Returns were high, risks seemed low, money flooded in. Over the past 15 years, this shadow lending system grew from nearly nothing to $2.5 trillion. That is larger than the entire GDP of France. It is a financial system the size of a country, operating completely in the dark. Here's where it starts to look very familiar. In 2007, before the crash, mortgage funds started quietly freezing withdrawals. Investors tried to pull their money out. The funds said, "Sorry, not yet." Nobody panicked immediately, but that was the first crack. Fast forward to 2026. In February, Blue Owl Capital, a $1.6 billion private credit fund, permanently closed all redemptions. Not temporarily paused, permanently closed. Investors who put their money in cannot get it back on their own terms. In March, Blackstone faced $3.8 billion in withdrawal requests on its $82.5 billion private credit fund, the largest redemption demand in the fund's history. Blackstone had to inject $400 million of its own money, including personal money from executives, just to stop a full panic. BlackRock, the world's largest asset manager, restricted withdrawals on its $26 billion lending fund. Investors asked for $1.2 billion back. BlackRock returned only half. Morgan Stanley received redemption requests for nearly 11% of one of its funds and returned only a fraction of what investors asked for. This is the exact pattern from 2007. First, funds gate withdrawals. Then valuations start falling. Then panic spreads. Then the whole system seizes up. Allianz Chief Economic Advisor Mohammed El-Erian, one of the most respected voices in global finance, said this week, "The similarities with 2007 keep me up at night. The fragilities are real, and they are not properly appreciated. Here is what makes 2026 more dangerous than 2008. And Wall Street does not want you to think about this. In 2008, the risky assets were mortgages. Regulators could see them. They were slow to act, but at least they could see the problem. In 2026, the risky assets are private loans to mid-sized companies that nobody can value with certainty. There are no public markets. There are no daily prices. These funds can say their loans are worth whatever they want until the moment someone tries to cash out." The Bank of England described it as leverage on leverage on leverage. Borrowed money used to buy assets, which are then used as collateral to borrow more money, which funds more loans. A tower of debt, where nobody knows exactly how tall it is or how much wind it can take. And here's the thing that connects it directly to you, the American investor. These private credit funds have been aggressively marketed to regular wealthy Americans, not just hedge funds and institutions, pension funds, retirement accounts, individuals who were told high returns, low risk, better than a savings account. Right now, there are Americans who cannot access their money, not because their investment failed yet, but because the fund simply won't let them leave. The $265 billion in market cap destruction across private equity and credit managers since early 2026 has already wiped out nearly 5 years of stock gains. And analysts say this is just the beginning of the repricing. Now, to be fair, not everyone agrees this is 2008. BlackRock CEO Larry Fink said this week, "I don't see any similarities at all." He argues that the safeguards put in place after 2008 have made the broader system more resilient and that the current stress is isolated to a small portion of the industry. And he may be right. Maybe this is a contained correction. Maybe the tower holds. But here's the question you should ask yourself. In September 2008, how many Wall Street CEOs were on television saying everything was fine? History doesn't repeat, but it rhymes. The $2.5 trillion private credit system grew in the shadows, beyond regulators, beyond public markets, beyond your retirement advisor's understanding. Whether this becomes the next 2008 or just a painful correction depends on one thing: how many people try to leave at the same time. That is the economic fault line of our moment. If you want to understand where the next break in the global financial system is coming from before it happens, subscribe to Economic Fault Lines and tell me in the comments, do you think we're heading for another 2008?